together to essential question number one. This is the one that was done on August 1st. It was about a small business that does energy efficiency inspections for homeowners. And the first one you take a look at here is you need a new blower door, which is a piece of equipment. It's what you use to measure leakage. And the idea is that you're paying cash for it. The idea is that for item number one, we'll do this one in black, you're going to have an increase in some of your fixed assets, and you're going to have a decrease in cash that's going on. And that's what you should see for one on the balance sheet. Please note that this balances itself out, so there's no need to do anything about owner equity or liabilities or anything like that. But also note that you're purchasing an asset. So what you're going to be doing here is seeing a decrease in cash from investments. That's the other part that goes on that. And that should pretty much close it out. There was this echo from the balance sheet over the cash flow, but nothing was going on in your income. The next one, a client hires you to create an energy efficiency remodel plan. You deliver it an invoice and the invoice to the client. So what you can think of is a bunch of things going on. The easiest one is that you're supposed to have some kind of increase in assets because there's an invoice out there. That's accounts receivable. You can also go ahead and say, well, look, this is going to have some increase in money or equity. And it also ends up being a whole bunch of things are possible. I'm just giving you credit mostly as long as your balance sheet doesn't have any balance. But you can say something along the lines of decrease in cash from finance, basically collecting money for the client, an increase in operating revenue, an increase in cash from operations, and that balances out to get more cash money. There's a whole bunch of possibilities there. As long as you identify a couple of these and follow the rules about entering a cash flow statement and balancing the balance sheet. Okay. Item number three, your regular thermal camera guy is gone, so you pay for the job. What we're looking at there is just an increase in operating expenses. That goes ahead and changes net income, and that gives you a reduction in cash from operations. That's what we're aiming for there. Moving on to item number four, you donate $1,000 to the local kids soccer club. On the income statement, you're going to see that as an increase in expenses. That echoes through the cash from operations as a decrease in cash from operations. Some of you will also catch on that has some balance sheet things, like you decreased your cash, which is an asset, which also decreases your owner equity. So that's also a possibility there too. Let's move on to item number 6. And going on to black again, you sell your old thermal camera. Well, that's a fixed asset that you're getting rid of. And what you're doing is you're getting cash in its place. So cash is the one thing. And then the other part of that is that you're actually getting cash there, and you're selling that, so that increases cash from investment. Item number 7 is the last one that we just did a loan we did last year. You're seeing a decrease in liabilities. That's the loan that's going away. You're seeing a decrease in your assets because what you're looking at is a decrease in cash used to pay it off. And you're also seeing a decrease in cash from finance because you're paying off the loan. That's the finance component. Think of it as where you're paying off the principal. Switching over to green, and you 5 invoices were paid today. So what you're seeing here is going to be an increase in cash. That's the cash coming in. A decrease in a bunch of other current assets. And those are those accounts receivable. And what you're seeing is an increase in cash from finance. Essentially, when you send out the invoice, you were basically lending your client money, and now they're busy paying you back. And that should go ahead and be the quick explainer to the essential question number 1 given on August 1st about the energy efficiency inspector business.